Hello and welcome to our webinar today. Very excited to be joined by some great guests. We have Rick Sains from Pollination Law is joining us as our special guest. I'm sure many of you have dialed in specifically to hear his views on these carbon markets, and also our regular partner in crime, or my partner in crime, whenever I'm talking carbon, is Erin Bloomgarden from CliFi. And very esteemed carbon experts, and the best guests we could have for a discussion like this. So today's webinar is focused on a carbon update, the EU market momentum, and the legal challenges to the California program that both give rise to concerns as well as create an incredible opportunity for investors. So that's what we're going to talk about today. This session also has a single credit for CFP and SEMA. So please email us at info@KraneShares or ce@KraneShares.com for those credits at the end of the session. And also throughout this session, we welcome questions. So please always, either if you're in in our website or in the Zoom, you can either enter the questions directly, or you can email us on info@KraneShares.com, and somebody here will put that in the chat for me, and I'll ask our great panelists. So something I want to really touch on. We're going to have to make this conversational, and then we're going to get into what we usually get into. So if we can get onto the next slide, just quickly let people know who we are. If this is the first time joining, you may not be familiar with KraneShares. If you've joined many times before, we're going to take the guidance that you've given us, and you want to really dive into the carbon market. So for those that are joining for the first time, I'm going to do a short, brief recap. But who we are KraneShares. KraneShares is a global asset manager and ETF issuer, and we focus on three main pillars that we think are probably the most powerful themes for investors to look at today. And that is China, this huge diversifier against the global economy. We've got climate and carbon, where we are the market leader, not just in China, but also in carbon markets. And we are also very focused on alternatives. And of course, China and carbon are some of the most powerful alternatives that you can have, but we also have a suite of managed futures, inflation hedged, option overlays, income generation, and so on in our alternative suite of products. So fantastic lineup of products, and today we're going to really zero in on those carbon markets. And so what I want to sort of do is just give a quick 101 on what these carbon markets are. I'm going to flip straight to slide 4 if that's okay. And what these markets are and what they are not. Carbon as an asset class. This is a $1 trillion asset class. Investors will be very surprised to know that this is not a niche, unusual, esoteric allocation for specialist money managers. This is a $1 trillion mainstream asset class that we are seeing at the moment being allocated to by some of the more sophisticated family offices, some of the more sophisticated endowments, and we are, especially with our ETF offering, making this available to all investors. And you might be surprised to know that the global price of carbon, as we track in our flagship fund KRBN, is actually up about the same as US equities. We were ahead of US equities as of yesterday, and we had a bit of a pop in US equities yesterday, so we're sort of neck and neck. So the performance is there. European carbon, you'll be surprised to know, over the last 12 months, it's up about 25%. And when you look at even UK carbon is up nearly 50% over the last 12 months. So these are asset classes that really move, and we can do so with low correlation. So what is carbon? This chart hopefully gives you just the kind of high level, and you're going to pick up a lot more as we go through the conversation. But what carbon is, these are government-run, government-issued carbon allowances. These are not people planting forests. These are not people making promises to be green. That's not what this is. This is an economic pricing signal that is put into economies in order to allow companies to optimize for their CO2 and methane and other greenhouse gas outputs. What does that mean? Well, the government, so the European Union is the biggest market by far. The California market is maybe second or third largest market. Of course, it's the 5th largest economy in the world. The UK, as well as the state of Washington, and also all the states in the northeast of the US have a program for power generation. And it goes on. We see China, we see Japan, we see South Korea, New Zealand, Australia, India, Turkey, all developing these programs. Even in the US, we've just seen a Republican, which you might be surprised to hear, bill put forward for putting carbon pricing on imports. So lots happening in this space. This is truly an economic price mechanism, and it is, as I said, backed by government. So quick rundown here: the governments issue the permits and they're sold at auction. They then reduce the number of permits that they auction every year. What that does is make this mandatory. So by law, if you're a company in these economies, you must account for your carbon emissions and you must buy allowances to allow you, permits essentially, to create that ton of pollution. So what that does is starts off with a relatively low price in a liquid permit that you can buy. And as you buy these credits and the number of these credits comes down, the price starts to rise. What that does is something very powerful. By having less of them, you put upward pressure on the price. And if you put upward pressure on the price, you make companies start to think the same way they think about everything else: how much fuel they use, how many people they hire, how many factories they have. Companies optimize everything. Humans engineer and optimize to reduce cost when there is a cost. But at the moment, there isn't enough cost to that CO2 that goes into the atmosphere. So by putting a price on it, you suddenly get companies reducing their emissions while finding ways to continue to maintain production. And that is the goal of these programs. These programs aim for us to have all the energy, all the products, all the quality of life that we have today, but doing it without the carbon intensity, the CO2 into the atmosphere. So let me just show you one reason why this is so powerful, and then I'm going to get into it with our guests. We can go to that next slide. This is the power of carbon markets. By having a price on carbon, you have an auction revenue that generates revenue for the governments. This is also why you get bipartisan support to these programs, because it creates revenue that can be spent in those economies to either activate various other, EV waivers, solar waivers, but also can be used in more general purposes as well, which why we're seeing so much support for these programs, despite them sounding like partisan. They tend to sound more left, but actually you actually see more support for these on the right, because they are this economic kind of capitalist way of solving this climate problem. So you get this great revenue. Secondly, by having a price, any company is going to make economical decisions. If coal is cheaper, they'll burn coal. But if coal, because it's got more CO2 emissions, means more carbon credits, meaning higher cost, you'll actually see companies switching to greener fuels. That might be natural gas in the short term, might be renewables in the long term. So you'll see this natural progression. And then thirdly, because there's a price on carbon, there is this great opportunity for innovation. Because there is a price on reducing emissions now, there is a huge wave of investment into technologies that will reduce emissions, whether that's green cement, green steel, nuclear, modular nuclear, battery storage, improving the efficiency of renewables. All of this is going to happen because there is a price on carbon. And the great thing about this is that it is not designed to make things more expensive. It is not designed to ban fossil fuels and stop us having all the things that we like to have. It is to create the catalyst for us to innovate into having all those things without the CO2 emissions. And what's really fantastic, and why this is a perfect solution, is the fact that if in that transition there are increases in costs for, say, energy, well, that's what that revenue can be used for, to subsidize that energy at the back end. So we are creating this flywheel of creating the innovation, scaling new technologies to reduce emissions, but also having the war chest of capital to bail out the inflationary effects. So it is a very, very well designed capitalist program. And why do we care so much about it? Well, you can invest in this price of carbon that is designed to rise. And so that's what we are getting along in our investment. And that is something that has high expected returns that have very low correlations to traditional asset classes. So before I go on too long, I get very excited talking about this. I want to bring in our guests, and maybe we can drop the slides and sort of get into a few questions. So I kind of went through the 101 there. Hopefully kind of covered it. And guys, definitely jump in if there's anything I missed that you think is a key element here. But you have a known supply of an asset and you have known demand for that asset, and they're backed by law. And so you have a very robust and therefore liquid market. So maybe
Hey, Luke,
yeah.
can I jump in just to keep this conversational? Man, that was a great 101. I have to say that was very excellent. I just for folks who might be confused about saying this is not about planting trees and this is not about corporate. Uh, the way I like to think about it is there are compliance markets that are government created permits to emit, and you mentioned it, allowances. But at the same time, there is voluntary action that does take the form of markets that operate similar to these compliance markets, but have fundamental differences in terms of, government mandated caps and the like. And just for those who might be thinking, wait, what happened to planting trees and all of that? You're describing the primary compliance policy design, which is cap and trade, and there are other, parallel designs out there and functioning markets that are operating well. And in fact, there's a point of convergence that's out there as well in these markets where some of these forest project type activities can actually be recognized by governments as well, and they get brought in, and so they add to the supply. And I know that's a nuance, but I just want to make sure that the listener isn't thinking that planting trees is no longer a thing. It's very much going forward.
Yeah,
Yeah.
if I build on that, and just to say, Luke, thanks for that great opener, and really excited to be on the line with Rick Saines. I've known Rick for like approaching 20 years now, and he's really one of the top experts in the world on these markets, and so really excited to have him. I wanted to make a few points. One, building on that, people have been hearing a lot about carbon markets over the last few years. There have been some Guardian articles, reputational things, and I think it's very important to build on what Rick is saying. Fundamentally, there's two different markets that are both kind of called carbon markets, and they intersect in different ways, but they're very different. There's a voluntary carbon market and a compliance carbon market. The voluntary carbon market is what people are hearing about typically, because these are the planting trees.
And not to interrupt, Darren, but should we flip up slide 3? It's a great slide that might help.
So these are the markets that people are hearing about because they're exciting projects like planting trees. And then the buyers of those projects are household names, the Googles, the Microsofts, the Amazons, right? That's an active market, but it's a very small market relative to the compliance market. It's maybe $1 billion, probably a bit under $1 billion. On the other hand, you have a global compliance market, and compliance or a regulated market, typically regulated through a cap and trade, where there's a cap on absolute emissions, and there is an allowance that's issued by the government, which is essentially the currency of the market. And these markets are not new, as you said. They've been around for well over 20 years. They're approaching a $1 trillion market, total market value. And so these are really exciting, we think, from an institutional sort of investor opportunity. In fact, I wanted to point out that there was just last week, the World Bank published their annual state and trends of global carbon markets report. I was surprised to hear that this is like among the top 3 downloaded reports the World Bank produces, right after the World Development Report. So this is a very popular report, and a few headlines there. One is 28% of global emissions are now covered by some form of carbon price. So this might be an emissions trading system, could also be a carbon tax. So that's a lot, but there's still an opportunity, of that, a lot of emissions that are not covered, and we're seeing the expansion of these markets. It's enshrined in the Paris Agreement. We're seeing a lot of activity around the world, including in places that you wouldn't expect, places like Brazil and China and India, developing their own cap and trade systems. And then on one of the previous slides, Luke, you'd mentioned that one of the key characteristics of these markets is that they generate revenue from auctions. And so, which actually makes them, from a policy standpoint, very sticky. because they start generating revenue that can then be used by the governments to invest in clean, green, and efficiency. And so in the World Bank report, they reported that $100 billion of revenue have been generated by these compliance markets. So these are really interesting, interesting numbers now, and there's a lot more in that report. So I encourage those, to download it, including a map of where these emissions trading systems are. So thanks.
Yeah, and you can
one
flash
thing to Aaron's deal, if you're interested in that, and I like visuals, despite the fact that I didn't prepare any for this webinar. There's a time lapse from 1990 to 2025 of the global map here, and I like time lapse because it gives you a sense of the momentum of policy instruments over time, or whatever the time lapse is covering. And you can see really interesting in the last 5-6 years, it's really starting to take root and populate specifically. And then within that, it breaks it down, as this map indicates, between emissions trading schemes, carbon taxes, crediting mechanisms, etc. So it's a really good report. It's kind of like the level setter for the market every year.
Yeah, I mean, and it's funny because what you guys highlighted speaks to the challenge I have, and I'm sure you guys have the same challenge. When you talk about this, you meet people that really want to understand how this is impactful, and they want to make sure this is an impact investment. And to your point, you've got these voluntary markets that are going to feed into the compliance markets, but you've also got the price signal element. And what I find is that to invest in these markets, there's not a prerequisite that you want to put capital into having impact. If you want to have impact, there's almost no more powerful thing you can do than contribute to the liquidity and price discovery of a global price on carbon. But if that's not important to you, there is still this, as you say, very sticky economic paradigm where we have an asset class that is designed to rise based on a single tightening schedule between now and 2050 that has that low correlation. So it's always, I always find myself talking the other side of the coin, which is the impact doesn't matter. You have something here that has an incredible risk return and low correlation as an investment product, and here's why we should be so confident in it as an investment. But it's also about the most impactful thing you can do. And so this really is a fascinating area. I'm sure we'll sort of dig more into it. But I know that, and we can drop the slide for a second. I know that this is an area that a lot of people have dialed in for today, is to hear out what's going on in the two major markets, which is California and Europe. I find everyone is excited and watching California like a hawk, and some people are either in Europe already or kind of are putting it, they're more focused on California. I think Europe is almost, if not more, interesting than California. So I love both these markets, but I know a lot of people have dialed in for California. So I'm glad, Rick, you're on. So let's talk about political, legal risk that is in the California market and how we see that changing and what that means for prices going forward.
Okay, great. I mean, you've used a political risk as a very broad topic. I mean, maybe just cutting straight to the chase. Let's talk about the executive order. So this administration is not friendly, knowingly friendly. I'll put it that way, because we'll talk about tariffs in a minute. Knowingly friendly to climate progress in terms of policy design. So the president put out an executive order basically instructing the attorney general to analyze whether there are any legal challenges that are viable to states who are taking climate action, including states like California and others. He calls out New York, calls out, I think, Vermont, and a couple others, and then report back in 60 days with progress on what the legal merits may or may not be for challenging particular actions. And I think, speaking bluntly and probably, non-politically correctly, I don't know that it's actually a proper legal strategy. I think it's probably more of a saber-rattling strategy to just create the appearance of vulnerability with some of these programs rather than actually, thinking that there's a real legal vulnerability there. I mean, in particular with respect to California, California's been challenged both domestic within the state, externally from the last time the Trump administration was in effect. And they've been sort of battle tested, let's say, in terms of, designing the program to withstand legal scrutiny. And they're very mindful of that. I mean, they're very sophisticated, all the way from the legislature, the executive branch, California Resources Board and the like, all of the implementing agencies and so forth understand that the world is watching what they do, and they're very mindful of how they go about designing their program. So from my legal, prognostication, if I could take that liberty, even though we're in unprecedented sort of political times, I think the legal merits of the program and this executive order and what the risk is to that are not something that I would be overly exercised about, frankly. So that's how I kind of come out on it. That's not to say that it doesn't have an effect, right? This is, if people are reacting to what they're hearing and they don't have time to study all of the nuances and the details, they might be impacted by understanding there's scrutiny being, applied to some of these systems. So, maybe this administration gets what they want, even without having a legal foundation to do it.
Yeah.
That's the executive order. There's lots more to talk about, but I'll pause there just in case anybody else wants to jump in.
Yeah. Well, I mean, it's probably worth recap. I mean, you're right. Any uncertainty affects prices, even if that uncertainty isn't likely to play out. I mean, one of my thoughts, and maybe I'll just recap for everybody. So the California market and has been in this newer phase than Europe. And about a year ago, it was starting to feel like the demand supply in this market was rolling over into shrinking surpluses, and the investment market kind of came towards California. We had a very strong performance year, followed by some delays in the program, and then this executive order from the current administration. And so that has kind of had investors go to the sidelines, which has caused the price to fall. And I'll get into it in a little bit, but the California market is very unique in that it has floor prices and ceiling prices. And so that makes this a very asymmetric investment, especially when you're trading near the floor as we are today. But this isn't, I mean, I got two thoughts, and I'd love both of you to answer this. One of them, these challenges aren't new. We've seen these challenges before. I'd like, you guys to kind of step in and talk about what happened in the past and perhaps why we shouldn't be worried about it this time. And then the other thing is just really my take on the executive order. If you're a California carbon investor, you're reading that in the context of California carbon. But when you read that executive order, it doesn't seem to say anything very specific about anything. Secondly, it's not about disrupting climate policy for the sake of disrupting climate policy. It's about ensuring energy independence for the US, which is a good thing, right? So, but the context was we don't want anything disrupting the US's ability to be energy independent. And one of I took it as the main drive was New York and Vermont and these states that are taking legal action on energy companies. And then it kind of listed third, fourth, fifth priorities, and California was somewhere further down the line. And I even think California's low carbon fuel standard is probably more in the crosshairs than the California carbon program. So I think the risk is overblown there. Maybe you guys could elaborate on that.
I can
articulate it well.
I think this is where you have politics intersecting with market dynamics, intersecting with law, and I think as you alluded to, Luke, this was tested in the first Trump administration when they went after the California program that went through the courts and the challenge was rejected, and so California prevailed. Rick can, I'm sure, talk more about that. So I think this is more of a political statement on behalf of the administration, the Trump administration, and I think that the effect actually, and what I'm hearing from friends in California is the effect is actually the opposite, where it's strengthening the spines of the California governor and legislature to to kind of rally it against it. There was a lot of, and politically in California, there are some big decisions that they have to make in terms of, what the future of the cap and trade program looks like post 2030. And I think this is strengthening the resolve there. So from an investment perspective, I think this uncertainty, the bark, I think, is worse than its bite. And I actually think creates an interesting opportunity where the market is actually undervalued. As you said, there's a floor price, which is governed by an auction reserve price. The market is trading right on that floor price. So there's it's sort of an asymmetric trade. And I think once this, policy sort of uncertainty works its way out, I think we'll start seeing that price, coming off that floor. So I think it's actually very interesting time. Now, how long that takes, less clear. Rick, maybe you want to.
Yeah. No, I can maybe speak to some of that. I mean, in terms of where the May auction results landed, yeah, it's interesting, right? Because if you go back to the historic results, this is right at the floor price, the statutory price, and it hasn't really gone down that far. So one part of this that's fascinating is, did the reserve price actually intervene here? And is that doing exactly what the statutory structure is intending it to do, which is to avoid massive volatility downward if there are blips in, political circumstances or some momentary uncertainties around the future of the program and so forth. But it hasn't traded at the floor price. So the point of this is that the system actually has been trading above the floor price consistently for a long time, and now we're at the floor price. So the question is that going to stay there, or what is it that's going to cause the markets to respond back to kind of a delta between the floor price and the clearing price? And to me, it's a little bit of a combination. You mentioned delays, Luke. There's a couple of things going on. One, the current statutory authority for the program, for California Resources Board to administer the program, runs to 2030. So they are in the process now, the legislature, of formally reauthorizing it post 2030. And the reason they're doing it now, interestingly, is to send a very clear signal well in advance of the expiration of the program so that the market isn't getting to 2028, 2029 without certainty that the program will obviously extend. And the governor has put an extension into the budget, and the budget discussions are supposed to be concluded by, in 10 days time or so. Unclear whether this piece of it will get through. I think the auction results in May are an interesting, indicator that there is the desire on the market's behalf to have the answer and have it answered in the affirmative. And so if it doesn't happen in the next 10 days, there could be some trailing bills, but I suspect, this is a guess, nobody knows for certain, but I have a sense that before the July auction, there's a desire to kind of wrap this up, and then send that positive signal to the market. So that's interesting. And the other thing is that the California Air Resources Board is also going through a regulatory amendment process to strengthen the existing program from 2026 to 2030 to allow the cap and trade program to be aligned with the targets that have been set originally by Governor Brown as sort of an executive order, but then ensconced in legislative action later. And these targets are very significant. I mean, they had a 2020 target, they have a 2030 target, and a 2045 target, right? And based on this system, the state achieved its 2020 target early, but it has a long way to go now. Like the curve of reductions from right now until going all the way down out to 2045 is much steeper. So they're going to need to make adjustments to the cap. They're going to need to pull supply out. They're going to need to think about cost containment. They're going to need to think about the role that eligible offsets play. And that goes back to this earlier point about forests and trees and so forth. And the other thing that's happening is, of course, California's been suffering through some really dramatic fire events. And as you mentioned, rightfully, there's a massive amount, about $4 billion a year in auction proceeds from these auctions. And there's a big discussion right now about how to spend that money and where to prioritize it, and maybe allocate some of that towards fire away from the general fund and use the auction proceeds to help fund the needs that the fire departments have to enhance their resources to combat climate effects. So there's a lot there, right? And I think California can be forgiven for trying to get this right and sort it out, and maybe there's some delays, but rest assured they are definitely focused on getting this reauthorization going, and also shoring up the cap and trade from 2026 to 2030. And we're just in that moment, that interstitial space before we actually have the concrete um, you know answer. But
Yep.
all, my sense is that the trend lines are positive on that.
And as investors, that puts us right in the sweet spot for timing and being in this market. And so before I switch on to Europe, I'm just going to recap, because I think you touched on all the key points just then, which is we have the executive order. The executive order, while creating uncertainty, doesn't really have any legal strength to it, even if this particular program is high up on the list of priorities. We are, I'll add, past the 60 days since the executive order and have not had anything from the Attorney General's office. And so perhaps that's over. It happened during the tariff conversations. Perhaps this thing is passed, but it certainly doesn't seem like it has teeth. Secondly, you mentioned the extension. I think we all want a clean extension. We don't need to renegotiate the program. Let's just get it extended. And we should see that, especially because it's in the budget, and that the state need those revenues. And that's why it's kind of got bipartisan support in California, because it's a revenue generating program. And then thirdly, is the amendment process. And when we see that process, so it's a 20% increase in the aggressiveness of the program. So when we see that come through, that's going to be incredibly powerful. So I think everyone, if you're looking at California, I think you should start to fade out the fears from the executive order. You should start to look forward to the extension, and then followed by the tightening of the program. And if we get all of those things, we will have a very significant price move, which I'm going to show on a slide in just a minute. But I want to switch gears, unless you guys had anything to add there. Hopefully I summarized what you guys were saying. Let's just talk about Europe for a moment, because Europe isn't pending any big changes like California, or looking for any big news, but we are at this very critical time where we've seen the performance coming back. And I think the big thing to talk about here is CBAM, Carbon Border Adjustment Mechanism, which is put in place to essentially level the playing field for European companies that are paying for these allowances against foreign imports. And I think there's a back door here where we actually start to globalize the price of carbon. And maybe we could talk a little bit about what that means. So Rick or Aaron, please jump in on CBAM and what it means for Europe.
Well, I was told I would get to be the special guest. So Aaron, can I take that liberty and go first?
Perfect. I was gonna look to you. Yeah.
Okay, good. Yeah, CBAM's fascinating. It's having a really profound impact on the way in which a lot of countries that export into the EU are thinking about their domestic scenarios, and giving full credit where credit's due. Aaron, you said it, and I'll give you the opportunity to say it well about, like, do you pay Europe, or do you keep that money domestically? So what you see in response to CBAM, and what it is a carbon border adjustment mechanism. 70, 80 euros a ton is being imposed on domestic industry in the EU to produce things like steel and cement and other industrial commodities. And they are seeing that, around the world, there are a lot of places where those prices are not imposed on domestic industry. And so if they receive all of these imports in from commodities produced without that price, there's a competitive disadvantage to domestic industry, and they don't want to just pull back from putting that price on those industries in the EU. And so that's where this border adjustment comes in, and it's correlated to the price, not to the ton. And there's a complicated formula for how you calculate the embedded emissions in a particular product. But what the consequence of that is that countries are saying, well, geez, I'm gonna have to pay 80 euro a ton tariff. How can I reduce that burden, that cost burden on my industry domestically? And one way to do it, and this is why you're seeing this proliferation emissions trading scheme specifically is to establish a domestic trading system the EU recognizes, and then there's a price on that domestically. Now that price gets reduced. So if a domestic price is $15, rather than paying the 80, they get to take that 15 and reduce it against the 80. They still pay the net, they still pay the 65, but they're not paying 80. 15 of that is staying in the domestic economy. So, and there's going to be different prices in different markets and different national circumstances, but that's to me the most direct correlation to where these ETSs are proliferating. A lot of that's being driven to me by the CBAM initiative. And then there's the US stuff, which we can talk about in a second, but maybe Aaron, if you wanted to jump in.
I thought that was great, Rick. I mean, look, I would just say, I just had a few quick things. I mean, traveling around the world as I do, I'm sure you do as well, Rick, in Middle East, Asia, Latin America. I mean, if you talk to European trading partners, they are taking this extremely serious. This is going to be a direct impact on their bottom line. They're scrambling to figure out how they're going to meet these goals. The Europeans also take their carbon market extremely serious. They're very committed, very dedicated to this market. And it's the largest by orders of magnitude carbon market in the world. So this is a very serious program and is driving, as Rick says, if you're a trading partner of Europe, you have an option to either have your industry pay Europe, essentially a carbon tax, or you create your own carbon price and keep some or all of that revenue internal. So no, I think this is really leading to a lot of expansion of carbon markets around the world. What I was going to say earlier is as Luke was saying, this is no longer a niche market. This is a real asset class. We've had traded markets for over 20 years, approaching $1 trillion. But in many respects, we're still in the maybe we're in the third inning here because, you can see China coming online now, the largest emitter in the world. They're getting very serious about carbon price. And so if you think about this as an asset class over the future, we're still in the relative early innings. The other thing, maybe Luke, this is where you're going, and maybe I'll turn this to you, given it's your homeland, right, is UK. The linkage with Europe and the UK, right? The UK came out of the EU emissions trading system with Brexit, but now there's talk about them coming back in. I don't know if that's the other theme. I think that's important to think about.
Yeah, and these markets are so it's interesting. I don't think we need a global single price on carbon in the same way we don't need a single global currency. But having these programs combine, have these programs start to overlap, I think is very powerful because you start to get convergences of price. And so the UK price was lower than Europe. The idea that they might combine them, we've seen year to date, UK carbon, which is 5% of our portfolio, is up nearly 52% year to date. Now that's a lot of performance. It comes with some vol. But yeah, to your point, we are early in these markets and we're still seeing them all grow. I think all of these prices, California is trading at $27. The target, we think, in the next couple of years is more like $65. You look at Europe's trading in the 70s, 70 euros. We think it should be about 150 euros over the next few years. So we're not talking about these performances sound like big numbers, but this is over the next few years, up to 2030. So these are high performing. We're thinking we're probably going to see something like a 20% a year return over that global basket over the next 5 to 6 years. And so very powerful returns that are coming from this. And the CBAM, so the carbon border adjustment, I think is this beautiful mechanism because, again, I keep putting this hat on where I'm not talking about impact. I'm just talking about the power of price. But by putting a price on carbon and Europe saying, if you want to come to our market and sell things, you have to pay a carbon tariff, but we'll waive it if you put your own carbon price. So it's the friendliest trade war. No one's doing anything aggressive. They're just saying, in this economy, we pay a carbon price. And lo and behold, two of the biggest importers into Europe, which is India and Turkey, have now put in place the beginnings of these programs. The US has even put forward a bill, which I think is fascinating. I'm convinced that Lindsey Graham heard about a panel I did at North American Carbon World last year, where I said it would be I had a very similar idea, and I'm very glad they're doing it because they're putting a bill that will attack the pollution on foreign-made goods. And my version of it was, let's put a tariff on the pollution caused by shipping, because part of the reason we ship jobs out and ship cheap goods back is because the people are cheaper that make it. They don't have the same regulations, and then they can ship it cheaply here. All of that creates so much CO2 that if you actually put a price of carbon on it, maybe it wouldn't be cheaper to make stuff overseas anymore, and we'd bring those jobs back. So I think there's an opportunity for this administration to embrace this and say this is a really smart way to bring jobs back to the domestic economy, to create a revenue, and also you can look left and right and say, look, we're bringing back jobs, we're making the country great again, and on the other hand, we're also reducing emissions and solving a lot of the climate issues that we've got. And so it is a really powerful tool, which, even though I'm talking about the economics more than the impact, I've got to tell you, if you spend any time in the data, we have definitely got a climate problem that is progressing and hitting some tipping points. We will have to address this, and not because we like nature, which most of us I think do. It's because simply we're going to have massive geopolitical risk if these imbalances in temperatures start destroying ecosystems where people live. And so
Yeah.
there's no way that we're not gonna try and solve this. And this is how to do it. And being in the Europe market, the California market, these earlier markets is powerful, because even if the federal government comes out with another program that puts tariffs, even if China's program develops before we're long, the fact that we are in the core markets as the tide rises, we are going to be in sort of the investment grade carbon markets, and then we'll start adding these other markets into our fund as they become more liquid. But right now we see ourselves as in like the investment grade, if you like. If you're talking like in the bond market, we are in the blue chip markets, which is California, UK, Europe, the northeast of the US, and we're watching closely the state of Washington as well, and we're watching very closely for new entrants. So, conscious of time, we always run on. We are getting some good questions, so I want to get into this. I am going to just, if it's okay with you guys, but please chime in. I want to show everybody just a couple of slides that I like to show that kind of just, we've talked about policy, we've talked about risk. I just want to show, if we can go to like slide 10. This is what the demand and supply in California look like today. If we can pop that on the screen. And so what you have is this purple line is the cap coming down. This is the basic tightening of this market. But what you need to really look at is the black line. That is the surplus of credits. So they auction credits every 3 months and the market buys them. Some people need to use them, like the companies. Some companies buy extras to hedge for the future. And some financial players, which is our job as the finance side of every market, whether it's stocks, bonds, or commodities, or carbon credits, is to buy undervalued assets, earn a risk premium, sell them back to the market when they need them and when they've achieved those price targets. And so we see that the past, you had a growing surplus. As it rolls over, this market will tighten, and that's when we're going to see the performance. So California, you can see there's a little bit, I don't know how clear it is, but you can see we flatlined. That flat line has extended an extra year because of these delays and because of these concerns that we've talked about. We are modeling that come 2027, we are going to go over this cliff and supply will start to taper rapidly versus the amount of pollution. Remember, pollution is coming down as a result of this price, but the idea is to tighten faster than the pollution reductions, to accelerate that innovation and scaling of renewable solutions. So that inflection point is just over a year and a half out, which is about the time where the market starts to price in those known futures. So as we get clarity on the policy that we talked about, we're going to see this happen. So let's just go to the next slide, because this is why everybody wants to talk California right now. California has a floor price. It has a ceiling price, and it has 2 tiers that offer sort of price resistance. They want the price to get to the ceiling, but they don't want it to get there too quickly. So they have those 2 bars, those red and yellow lines where they sell extra credits at those prices. So that acts as resistance, but that's okay, because right now that first tier is at about 60, and the floor is at about 26, and we're trading around 27. So we are right at the floor. And here's the kicker. All of these lines increase by 5% every year plus inflation. If inflation is 3%, every year these all go up. All these lines increase by 8%. So if we're trading at the floor, your base case is you have an 8% increase. If you get the policy improvements and you get the executive order goes away, then your trajectory gets steeper. So the better the news, the steeper it gets. But your sort of base case for nothing happening is we trend along the floor, which is, especially as we've come a little lower since we made this chart, is about 8% a year. Now, if you get all of those things come through, we go on the steep trajectory and we go up and hit that yellow, that orange line in the next couple of years. Why? Because you can model that the surplus will run out by the early 2030s. So at a minimum, they're going to have to buy, the companies are going to have to buy credits at the orange line. And if you discount that back to today, you're going to be above the current orange line, which will be 64 next year. So 27 bucks, your floor is 26, your next resistance is at 64. Very, very attractive. So we can go to the next slide. I want to spend some time on questions. So you can just see some forecasts here. We will share the deck and you'll all be able to see these forecasts. We're trading at 27. You can see these forecasts are all much closer to 100 by 2030, if not well above 100, which is what the state of California themselves are forecasting. So if we go to, let's talk about Europe for a minute. Let's just look at the same slide for Europe. I always talk about Europe. California has this very exciting floor price to ceiling price. If we can just go to the next one for the supply demand, it has this very exciting kind of binary. We're at the floor with this 8%, or we're going to the moon. Europe quietly is going to put up steady returns because they're in a much more mature, stable position. And so if you look at Europe, the cap's coming down, so is the surplus, which is the black line. You can see it popped higher during COVID, less economy, less pollution, less demand for carbon. But otherwise, it's been trending lower, which is why prices have been rising and have been steadily rising. We had something that disrupted all of this about 3 years ago, which was the invasion of Ukraine, which completely disrupted natural gas supplies, which is what Europe was moving to away from coal, and completely disrupted this market. So as a result, the policymakers flattened the curve. You can see I've circled it. That flatter curve really hurt prices. We saw carbon prices come down from 100 down to about 65. We're now back into the 70s. And as we get to the end of this year, you'll see the black line rolls over and starts heading south again, which means tighter supply, which means higher prices. And that's why, we're up 25% over the last 12 months in Europe, and we're up about 5% year to date. So really starting to see this rollover get priced in. If we go to the next slide, what are people forecasting? We're seeing these numbers. So we're in the 70s today. By the end of the year, a lot of people are starting to price us getting up above 80, and by 2030, you can see those sort of 150 type return expectations. So this market is designed to rise and rise in real terms, and so that does something really interesting. I'm going to keep going into why not only we see this going up, but why is this a great portfolio tool? And then I'm going to get into questions. So if we can go to slide 17. Slide 18, we're going to jump straight into it here. So these are our tickers, but here's why, as an investor, you should be attracted to this. So we've talked about all of these high expected returns in these markets. You blend this portfolio together that all have low correlations to each other, because it's not a single, carbon isn't a single thing. It's each market's carbon permit, which is based on its demand, its supply, that particular economy's energy mix, that particular economy's use of energy, whether, some countries are using more AC. In England, we don't use a lot of AC. So different seasonalities. And so you get this blended annualized return since 2014, when this benchmark was put together, of about 18 to 20% return a year, with annualized volatility about double that of equity. So roughly double return, double vol, which gives you a Sharpe ratio almost the same or comparable to US equities, US large cap equities. But with a 0.3 correlation. So when you think alternatives, and this is taking off carbon hat, taking off climate hat, and just saying, what is the perfect alternative? It's something that performs and has the same risk return as US equities, which is about as good as it's been, but with a low correlation to US equities. And that's what you get with the global carbon baskets. You can see there 0.3 correlation to equities, Sharpe ratio comparable 0.68 versus a 0.74. And you do that with low correlations, you get an incredible result. And if we should go to the next slide, you'll see what happens when you put this in a portfolio. And so not only could you switch out some equities for this, some fixed income for this, if you invest in any alternatives, which most investors need to make room for now if they haven't already, this is a perfect fit. And think about commodities. Everyone sees commodities as a sort of entry point into alternatives, low correlation, inflation hedge. Carbon does all of that explicitly with the carbon adjustment that you get in California. But also, these markets are designed to rise in real terms, whereas commodities generally only rise in relation to inflation. And so when you so long term, commodities are expensive to hold, but they are a good diversifier and a good inflation hedge. You take carbon, you get those benefits plus a real return. So put this in a portfolio versus commodities, you get much better results in an efficient frontier using carbon versus commodities. So maybe split the ticket, commodities and carbon, or wholesale switch out carbon. So for us, we could go back to that ticker slide. KRBN is our flagship ETF that gives you global carbon. KEUA is our Europe only, 100% allocation to Europe, and KCCA is 100% allocation to California. So KRBN is 60% Europe, 25% California, 5% each Northeast, Washington, and UK. So with that, I want to make sure we do get into these great questions. Let's see. Yes, we will be sending out the presentation. Just email us at info@KraneShares, and we'll be sure to do that. Guys, let me send this both Rick to you and Aaron, please chime in. How do you view the likelihood of preemption of a state-run program like the California ETS at a federal level under Trump?
It's unlikely. It's unlikely.
I think it's that simple.
Yeah, it's pretty simple. There has to be a legal basis to do it. There has to be a legal statutory, specific articulation of a particularized, statutorily approved mandate that the state is not consistent with, which doesn't exist. So
that's great. I've got this. We have one person asking lots of great, insightful questions. So I'm going to try and get through a few of these. Does Trump responding to CBAM as a national issue make carbon pricing a federal versus state issue and therefore subject to preemption? Or is that the same answer?
same answer. Yeah. I mean, that's interesting. That's a more thoughtful question, in terms of like starting to lay it out. But yeah, I don't think so.
Okay. Well, this one, you mentioned the extension. You'd like to see that associated with the budget, or implicitly at least, the budget will speak to the extension. What's in your view, will the ISOR package, which is the tightening of the program package, will that be this year?
I think there's a decent chance it'll materialize this year, or if not, early next year. I think they're really focused on it and wanting to get it right. That's what I would say. I am not concerned about this delay. I know it's causing sort of some hand-wringing and basically some uncertainty around that. That makes sense. But the folks that are responsible for it at the Air Resources Board are very seasoned and really good public servants who are doing their job to try to get this right and really, focus on all the, frankly, competing interests, associated with what's going to happen when there's a dramatic tightening of the cap. in light of the need for cost containment and the various allocations of free allowances to industry and electric utilities and some of the other programs, and how to reconcile some of that without, you know, without causing too much disruption in consumer pricing for, essential services. So that's really what's happening here, and really trying to focus on that. And I suspect it'll be Q4 this year. It's my best guess, but it's just a guess.
Yeah. Yeah. And hopefully, I think it's important to triage it, and have the clean extension, get that done, and then focus on that.
And then exactly then.
Maybe one thing we didn't get into too much detail on, and maybe we could just talk about a few the specifics. Two different people are asking about the specifics. How can the federal government attack these programs? And maybe we could just spend a few minutes on the specifics of what those risks are.
Yeah, I mean, I'm not excited about, offering legal theories for how to attack programs, but there's the Dormant Commerce Clause, which is basically saying, states can't provide barriers to trade or economic protectionism in terms of cross-state transfer of goods and services. And so there's been some challenges around programs that put a price on carbon, and the means by which they put a price on carbon. A good example was some of the for the low carbon fuel standard. Historically, some of the Midwest-based biofuels producers were concerned because the way that program worked was based on a carbon intensity formula per molecule, and the carbon intensity was an overall life cycle assessment, right? Which means that you factor in how far away a lot of fuel needs to travel, and by what means, and what's the source of the energy that's producing the ethanol, for example. And so if you have a coal-fired boiler that's producing ethanol versus a California specific program, there's going to be a difference in the carbon intensity, and the carbon intensity resulted in different economics associated with each of those credits, because one had a higher carbon intensity and one had a lower carbon intensity, and so the one was more valuable than the other. And there was a concern about Dormant Commerce Clause issues associated with that, but that was challenged and not successfully. There's been challenges on domestically around some constitutional issues in the state of California around taxes and having supermajority legislative approval of any new taxes. That was unsuccessful in large part because the arguments that an allowance is not the same as a tax, and I kind of think you got into that earlier. And just everything you're saying about if you hold an allowance today, it could be worth more tomorrow than it is today. So that's not the same thing as a tax. But from a federal government perspective, I think the question that says, well, if the administration embraces carbon border tariffs and sets a carbon price specifically and articulates a whole regime for pricing carbon in a unified way for the country, does that give them more of a legal foundation to say there's a preemption there? I mean, that's an interesting point. I think it would make for a stronger case, but I think preemption is it's very specific. I mean, we have a federalism is the way the country works, and the irony of this, of course, is that the GOP, the Republicans, have always long argued in states' rights and limited federal government and all of these things. And so to be using the federal government as talk about preemption and not, respect states' rights is kind of makes them perform a very uncomfortable yoga position that they're not used to. So, I don't know. I'm not overly exercised about it in one way or the other.
No, it makes a lot of sense. And just because we've hit the hour, I'd love to go on a few minutes and just try and answer these questions. But if you're on and you're earning credit, you don't have to stay on longer. We've had people message us and say, "Hey, I need to get somewhere. Can I?" You're allowed to hang up. But I would like, we've got some great questions here, so I'd love to explore a few more of these. So one here I like, and maybe I'll take a stab at it. But with such large accumulated surpluses, why would pricing move in the next 1 or 2 years if deficits are still some ways out and companies can buy the accumulated inventories of allowances? I'll take a shot, and maybe Aaron, feel free to jump on the back of it. But this is because this is a financial market. This is and it's a financial asset. And what I mean by that is compare this to commodities. If you have a barrel of oil and you have a 1 year future on the barrel of oil, it's very unlikely that that 1 year future is going to deliver this barrel of oil. Generally, the commodities that exist and are out of the ground have to get sold, and they're going to get sold now. And so there's a clearing price in the spot market, and then there's a different clearing price for those futures that is based on the supply that we expect to see for that future date. So you end up with futures curves, which are very, you look at natural gas is very seasonal. Every commodity has a very special shape of its curve that reflects its harvest, its how long it takes to ship it, how long it takes to refine it, how much it costs to store it. That is what makes commodities complicated and sometimes expensive to hold. Carbon, you buy one of these credits and you can hold them for free, you can transfer them for free, and they last forever. And so that is something that you can hold and wait and bide your time inexpensively. So what that means is you should be pricing it more like a stock or like a currency where everything you know about the future can be discounted back to today at a risk-free type rate. And so when you look at the futures curve for carbon, it looks very linear. It basically looks like what is the treasury rate? That's how steep the curve is, because you're getting a 1 year forward, and therefore it's priced with the time value of money against the risk-free rate, essentially. And so why, when we know something is going to be tighter in the future, should we clear at the current supply? So if there's a surplus today, you're arguing should prices be cheap because there's a surplus? Well, we're seeing that, but we know that it's tightening in the future. So if you apply financial modeling to this, and it blows my mind that not everybody is doing this, is you can discount back what you know about the future to today because you have an asset that you can hold until that time very cheaply. And so we should start to see the future known changes being factored into today's price. And so that's something that I think is an inefficiency in these markets. And as they grow, that will become less, but already trading $1 trillion. So what I found anecdotally is about a year or so out from these known events, you start to see the market pricing it. They're a little wary. They don't want to get in too early. And so we see the investor or even the corporate hedgers being very mindful of their deployment of capital into this market. So we are about a year and a half out for these big changes in California. So right now is when you should be building positions. Europe, we're already in it, and that's why we're up, 25% this year in Europe, because we're already inside that year and a half from that change in curve shape. So that's why the surplus today, we know how it's going to change, and so we can model that, and we should be pricing it today, same as we do with future revenues in equities. So that's my answer on that. Maybe let me try one more. And this is another one. I think it might be a tricky one. Just came in from Eric. Isn't it a bigger risk that Trump tries to withhold federal funding to get CA to stop carbon, like he has tried with NYC and the congestion zones? And I'll also add, like, I just don't know that Trump or anyone has a specific like hatred of carbon pricing. It's more about getting more flow of capital and energy across the country. So I sometimes think that might be slightly off, that's his design, that he wants to disrupt carbon.
Yeah. I mean, I think, well, just a reaction to that. I mean, I think Trump's already threatened withholding of funds, across the board, and, obviously sent Marines to LA So it is an important point. I mean, I don't want to just be too dismissive. I mean, this particular administration and this president is willing to do things no other president's ever done before. We should all acknowledge that. That's the world we live in. That does create a sense of, uncertainty around the globe. And everybody feels it in some form or another. But with respect to, how that plays out specifically to California cap and trade and California's laws related to climate change, I just don't see there being a legally sound and robust pathway to, a successful strategy. If in fact, as you say, there isn't even is one to do it. There's so many other kind of like in the moment kind of, reactionary moves that happen in any given day that this is just a way too hard of a battle to fight and to win legally, that I just don't see it being the thing that's gonna, consume this administration's time and effort.
Yeah, yeah, I feel similar that this is just there's bigger fish to fry, and I think these next 6 months are going to be very telling for California. And as I keep saying, while we're watching this very dynamic California story, Europe is quietly plugging away and doing its thing, doing what carbon's designed to do, which is to rise up at a moderate level, keeping pressure and keeping people fuel switching and finding better ways to produce goods and power. So I'm going to try to see if there's one more question. People are still hanging on, and I just want to be very respectful for everyone that asked questions. If we did miss any, we will come back. Just one question I think is important. Somebody asked here, well, there's a few questions about China, Sub-Saharan Africa, questions about other markets. Aaron, maybe you could just touch on, do we intend to include more markets in our strategies?
Yeah, very quickly. KRBN tracks the S&P Global Carbon Index. That index, which we helped create, is structured in such a way that it will add new programs when they reach certain volume and size thresholds. So, for example, we've recently added the UK and Washington State, and so if there is enough liquidity, if there's futures available, then we would it would consider adding those markets in the future.
I think that's it. I think that, this market is growing. We're going to see continued growth. We will add markets that are, up to the same standards as Europe and California and the UK, and we'll watch for liquidity. Of course, it's a publicly traded product, so we're very conscious of liquidity being a key input to that. We also offer physical credit offerings via private fund as well. So we do have, as an asset manager, a full suite of products. We've also launched a product in Europe which tracks the same global index. It's also called KRBN, listed in London, Milan, and in Germany. For investors in Europe can access that product as well. So, I really appreciate everyone's time. Thanks for joining us. Rick, Aaron, as always, thanks so much for being with us. And we will get back to people. I'll probably have more questions for you guys to help answer for some of the investors that come in with questions later. And we look forward to seeing you all. And as always, please sign up for our weekly blog where we talk about this topic. It's Climate Markets Now. You can find it on the KraneShares.com website. And thank you all for joining us. Thank you very much.
Thank you.